Okay, let's just dive right into this explainer and tackle the notoriously complex world of financial instruments. Seriously, if you've ever looked at a company's balance sheet and just felt this looming sense of dread when trying to figure out the debt, equity, and all those weird derivatives sitting in between, you're absolutely not alone. Today, we're going to transform those dense accounting rules into a clear roadmap. We're breaking down the actual logic behind the standards. That way, you're not just memorizing rules, you're really understanding the underlying economic reality. If you're feeling a little overwhelmed by the sheer volume of these standards, don't worry. We've got a really logical plan today to conquer this beast. We're going to cover the hidden debt problem, defining financial instruments, the classification maze, the amortized cost engine, and finally, splitting compound instruments. Let's get right into it.
Section 1, the hidden debt problem, bringing risk to light.
So we have to start with the origin story. Why do we even have these incredibly detailed rules for financial instruments in the first place? Well, historically, the main villain was off-balance sheet finance. Before these standards came along, it was basically impossible for users of financial accounts to figure out the true nature, the amount, or the actual cost of a company's debt. I mean, vast amounts of risk were literally invisible to the everyday investor. So the International Accounting Standards Board had to respond. And since they couldn't fix it overnight, they tackled it in 3 phases. In 1995, IAS 32 forced companies to finally present and classify these instruments. Then in 1998, IAS 39 came in for recognition and measurement, which, by the way, is now being replaced by the modern IFRS 9. And finally, in 2005, IFRS 7 mandated all those extensive disclosures we're so used to seeing today. Think of these foundational standards as the flashlights we use to expose hidden corporate risks. Moving on to Section 2, defining financial instruments, the taxonomy. Let's establish a bit of a rhythm here by clearly defining the core creatures in our accounting taxonomy. A financial instrument is simply any contract that creates a financial asset for one entity and a financial liability or equity instrument for another. It's essentially a two-sided coin. So let's look at the first side of that coin. A financial asset is, at its core, your right to receive value. That could be cash sitting in the bank, trade receivables from a customer, or shares you own in another company. The absolute key word here is right. You hold the legal power to receive a benefit. Conversely, a financial liability is the exact opposite. This is a strict contractual obligation that you have to deliver cash or assets to someone else, and potentially under pretty unfavorable conditions. Notice the wording there. Contractual obligation. This isn't a choice. You are legally bound to hand over those resources. And finally, we have the equity instrument. This one is the simplest, but honestly, the most crucial definition. Equity is whatever residual interest is left over once you take all those assets and deduct all those strict contractual liabilities. It's the ultimate bottom line of ownership. Now, what's really interesting here is a classic exam trap, and a very real trap for financial analysts in the real world. Suppose a company buys a building and promises to pay for it using shares in 6 months. How do you account for that? Well, if the number of shares issued is fixed, it's actually classified as equity, and we deal with it under IFRS 2 for share-based payments. But if the number of shares variable, meaning the quantity fluctuates based on the share price just to meet a specific dollar value, it stays a financial liability under IFRS 9. That distinction between fixed and variable, it is absolutely everything here.
Section 3, the classification maze, sorting the instruments.
So the crucial point now is how we actually categorize these instruments once we've defined what they are, because this entirely dictates how an instrument is going to hit the profit and loss statement. When a company holds a debt instrument, like a bond, they usually want to use amortized cost, because it's a nice, smooth, predictable accounting method. But to be allowed to use it, the instrument has to pass 2 critical tests. First is the business model test. Does management actually intend to hold this instrument until maturity rather than just trading it? And second, the cash flow characteristics test. Are the timings of the cash flows fixed, and are they purely for principal and interest? If it fails either of these, we're thrust right into the volatile world of fair value. And that leads us perfectly into the 3 specific classification categories. If your intention is short-term trading, or if the instrument is some complex derivative, it goes straight to fair value through profit or loss, or FVTP&L. This is basically your default category if things get confusing. Now, if your business model is a mix of holding to collect cash flows and selling assets when the time is right, you use fair value through OCI. And, like we just mentioned, if you're purely holding it to collect those fixed cash flows, you're safely in amortized cost territory. Section 4, the amortized cost engine. Running the numbers. Okay, let's dive into the actual math and see how this amortized cost engine runs over time. This is where the theoretical rules turn into hard numbers on a balance sheet. But before we do the heavy calculation, we really need to clear up our terminology, because honestly, these terms trip up even seasoned professionals all the time. The par value is just the nominal face value. Let's call it 100. If it's issued below that, it's at a discount, above it, a premium. The market rate bundles together the coupon rate, any discount, and any premium. But pay attention here, because the most important number is the effective rate. The effective rate is your market rate adjusted for the transaction costs of setting up the deal. It is the true comprehensive cost of the financing.
Let's look at an example to make this super concrete. Imagine a 4-year loan note with a nominal par value of $100 million. But it's issued at a discount of $12 million, and we have to pay $2 million in transaction costs. So what is our starting asset value? Well, 100 minus the $12 million discount gives us proceeds of 88. Then we capitalize the $2 million in transaction costs, effectively adding it back in. That means on day one, we recognize an initial financial asset of exactly $90 million.
So here is that amortized cost engine actually in action. We start year one with our $90 million balance. For our interest income, we use our effective rate of 10% on that opening balance, which gives us 9. But the cash interest we actually receive is based on the 6% coupon rate applied to the 100 par value, giving us just 6. I like to think of that 10% effective interest rate as the true internal engine of the instrument, while the 6% coupon rate is really just the cash exhaust coming out the back. The difference between the 9 we generated and the 6 we received is added back to the balance, carrying down 93 to the next year. And over 4 years, this engine just steadily grows that balance all the way up to its final redemption value.
Section 5. Splitting compound instruments, the Jekyll and Hyde.
Now let's examine compound instruments. These are basically the fascinating Jekyll and Hyde of the accounting world because they literally have two distinct personalities locked inside one single legal contract. The absolute classic example is a convertible loan note. It acts exactly like debt because it pays interest, but the holder also has the option to convert it into equity shares later on. And because IAS 32 demands that we look at economic substance rather than just legal form, we can't just lump this onto the balance sheet as one item. We have to manually split this compound instrument into its distinct debt and equity components. Let's see how this builds in practice. We use a 3-step process, which is honestly a great, easy-to-follow recipe that breaks what looks like a terrifying calculation down into bite-sized logical pieces. Step 1. Calculate the present value of the pure debt cash flows. Step 2. Subtract that debt value from the total cash proceeds of the issue, and whatever's left over in Step 3, the balancing figure, is your equity component. Let's run the numbers. Imagine a 3-year, 6% convertible loan note with a par value of 100, issued at a discount of 4, but redeeming at a premium of 3. Let's say our market rate without the conversion option is 9%. First up, we have to identify our pure debt cash flows. So we're going to pay a fixed $6 coupon for 3 years, plus a final redemption value of $103 in year 3. We then need to discount all these future cash flows back to today's value using that 9% market rate. Here's how the math shakes out. We take that $6 annual interest and multiply it by the 3-year annuity factor at 9%, giving us a present value of roughly 15.186. Next, we take that $103 final redemption chunk and multiply it by the year 3 single discount factor of 0.772, giving us 79.516. When we add those together, we uncover that the true economic present value of the standalone debt component is exactly $94.702 million. Boom! Step 1 is complete. Now for the final magic trick. We know our total proceeds from issuing the instrument were $96 million, right? Because that's the 100 par value minus the $4 million discount. So if we take our $96 million in cash proceeds and subtract the calculated debt component of $94.702, we reveal a balancing figure of exactly $1.3 million. That $1.3 million is the isolated value of the equity conversion option. We have successfully split the atom of this compound instrument. We've covered incredible ground today, from the historical necessity of shining a light on hidden risks to mastering the amortization engine and finally splitting complex compound instruments. So as you analyze financial statements and look at these seemingly dense instruments going forward, ask yourself a question. Are you just blindly accepting the legal form presented to you? Or do you now have the structural tools to dig deeper, calculate, and uncover the true economic substance? Thank you so much for exploring these critical accounting concepts with me today. Keep questioning those numbers, and I'll see you in the next explainer.
Beautiful people, how are you? I hope You are doing fine wherever you are. Yes, in this particular week, we are going to tackle about 3 accounting standards. Yes, the first one we are going to look at is IFRS, all standards related to financial instruments. That is IAS 32, IFRS 7, and IFRS 9. All right. We're also going to look at IAS 12, that is income taxes. Then lastly, we'll look at IFRS 16, leases. We hope after these standards, we would have covered much of the ground required for somebody to just enter into the examination hall and come out with around 60-70%. Remember, we are going to have a mock, an interim mock at the end of July. That is on the 31st of July. It will be a Friday, and we are going to give you the mock test to cover everything from consolidated financial statements, all the IFRSs and IACs, which we would have covered so far. Is that clear, guys? So I want you guys to watch these videos with all the effort, all the zeal required of one to pass this examination. Now, here's the background of financial instruments. There has been some inherent difficulties associated with this area of financial instruments. It is hard for users to assess the nature, amount, and cost of any debt and equity resources. It is always a challenging area. In the examination, you'll be given some scenario and you need to pinpoint if a certain transaction is all about equity or it is about debt. There is always going to be, this complex decision-making phenomena. So by the end of this video, I'm quite convinced that you will be in that position where you will be able to pinpoint whether this transaction is relating to equity or that one is relating to debt. Before IAS 32 and IAS 39, many financial instruments were treated as off-balance sheet finance and invisible to the user of accounts. Because of their significance, the IASB tackled the project in 3 phases. That is, IAS 32 presentation was issued in 1995 to ensure the users were aware of the instruments and risks associated with them. Then came IAS 39, that was around 1998, which talks of recognition and measurement. And this is the standard which has been precluded, or let me just say subsided with IFRS 9. The purpose is to prescribe specific accounting treatment of various financial instruments. Then IFRS 7, that is in 2005, came about to prescribe the disclosure requirements for financial instruments. With this background, let us dive in. Ladies and gentlemen, these definitions should be cast deep down our hearts because, to get a 50% shows some maturity in terms of content, in terms of theory, the accounting theory. So these definitions should just come out as simple as eating sadza. Yeah, you just have to spell them out so freely. What is a financial instrument? This is a contract that gives rise to a financial asset of one entity and a financial liability or equity instrument of another. Please pay careful attention. Liability and equity normally go hand in hand, but they are very different. They move hand in hand because we all know that the balance sheet equation, the accounting equation rather, is assets is equal to liability plus equity. I'm sure you have heard of that. All right. So liability plus equity is equal to asset. So the asset is usually on the debit side. This one is the debit, and this one is the credit. All right. So to increase the asset, we debit, but to increase both equity and liability, we credit. So this is why they always move hand in hand, but they are different. So in the definition here, a financial instrument, if you say the transaction is a financial instrument, you haven't said anything, right? You are only talking about a contract that gives rise to a financial asset of one entity and a financial liability or equity instrument of another, which means if we're having a financial asset, or let me just say, if we are having a financial instrument, two things would have happened. Either a financial asset and a financial liability or equity in another company. So a financial asset might be in company A, but we expect a corresponding financial liability or equity in company B. Is that clear? So now, what is a financial asset? We are talking of cash itself. Cash itself is a financial asset. So when we talk of cash in the book, in the safe or at bank, we are actually talking of financial instruments, but they are financial assets. So the cash or equity instrument of another entity, contractual right to receive cash or other financial assets, trade receivable, for example, trade receivables, loan notes, debentures, potentially favorable derivatives, etc., or a contract that can be settled in the variable number of the entity's own equity instruments. If we are going to receive our own equity instruments, and may be either a derivative or a non-derivative. So sometimes the contract might stipulate that we are going to receive our own equity instruments. In that case, it is called a financial asset. But be careful, when it comes to the receipt or issue of equity instruments, that is shares, we're talking of shares. When it comes to the receipt or issue of equity instruments, they need to be variable. Those instruments need to be variable. If they are of a fixed quantity, then they cease to be under financial instruments. They will be treated by a different standard, and we covered this standard that is in week number 4, where we talked of share-based payments. Is that clear? Good. Now, financial liability. Contractual. This is a contractual obligation to deliver cash or other financial asset. If you are delivering a financial asset, contractual obligation to exchange financial instruments under potentially unfavorable conditions. A contract that will or may be settled in an entity's own equity instruments for which the entity is obliged to deliver a variable number of its own equity instruments, then that will be a financial liability. This is now different from receiving our own equity instrument, but we are now delivering them, or we are now issuing them. If they are of a variable number, right? If they are of a variable number, that is a liability. But if they are of a fixed number, then again, that will be settled. That will become an issue of share-based payments. Is that clear? Good. So this one is the financial liability. Equity instrument. This is the contract. This is a contract that evidences a residual interest in the assets of an entity after deducting all its liabilities. So this is, the prime definition of equity. Now, let us look at this example on financial assets. Suppose A wants to sell a building to B for 100 million, and B is paying for the building using shares in 6 months' time. The accounting treatment depends on whether the shares are fixed or variable. If variable, where the share price decides, the entry in A's books would be debit financial asset 100 million and credit the building. We are receiving a variable amount of equity instruments, right? We are receiving a variable amount of equity instruments linked to our share price. Remember, using shares. So if the quantities of shares is variability being induced by the share price itself, then that becomes a financial asset. The receipt of those shares becomes a financial asset, whilst we are derecognizing the building because we are selling it out, but we are receiving a financial asset in the form of our own equity shares. Let us look at this systematically. Why are we calling it a financial asset when we are receiving our own shares and in a variable amount? Ladies and gentlemen, the price is known. Okay, the price of the building is known, but the quantities of shares is not known, right? So goes up. The quantity of shares becomes less. So our shares with B, guys, this is a situation where we are talking of own shares. It's an own shares situation. So B wants to buy the building using our own shares. Maybe he was a shareholder, all right? But he wants to buy the building. He's using our own shares. So in that case, if the share price goes up, the quantity of shares is going to be less. However, if the share price goes down, the quantities of shares is going to be more. But we don't care. All we want is the amount of shares equivalent that is going to be equivalent in value terms to 100 million. So we're not worried whether the share price is going down or is going up. That's his business. So this is why we are saying if we are not worried about the amount of shares, then it becomes a receivable, a financial asset. Are we together? However, if the amount of shares is fixed, to say you are going to give us 500 shares to take over the building, then in that situation, we are tied like ordinary shareholders, all right? We are tied up. So that will be equivalent to a share buyback exercise. We are buying back our shares from B, and this is why we are debiting equity. We are reducing the amount of shares in the market. We are buying back from the shareholders. So we are reducing the shareholder spread. We are reducing the equity spread. It is shrinking, right? So the credit entry is 2 in both cases, crediting the building because we are disposing of the building. However, the treatment, guys, is that clear? So if they are paying us with our own shares, then we are going to debit equity. Is that clear? Now, let us look at another situation where we are also in the own shares paradigm. We are still in the own shares paradigm. Suppose A wants to buy B's building at 200 million and promises to settle in shares. So A wants to use its own shares to buy B's building. How is A going to treat this transaction if the shares are going to be variable, if the quantity of shares is going to be variable? So in that case, A is going to debit the building because he's buying the building and credit financial liability. As long as the shares are going to be variable, then it becomes, in substance of a form, a financial liability, which is under IFRS 9. But if the shares are fixed, yes, he's debiting the building because he's receiving the building, he's bought the building, so debit the building and credit equity. He's crediting equity. Why? Because the amount of shares are going to be fixed. So it's like he is issuing out. He's issuing out the shares to B. So B, in a way, has become a shareholder. So that's the essence, guys. That's the essence. That's when shares issued are fixed. The transaction ceases to be a financial instrument, but ought to be due to under IFRS 2 share-based payment. So the following summary is relevant. In the own shares situation, if you are receiving own shares and the shares are fixed, what you need to do, you need to debit equity. We've seen this one, and credit the asset. Why? Because you are receiving own shares, and this should be a situation when you are selling your asset or you are disposing of the asset. So if you are being given fixed amount of shares, fixed quantity of shares, then you need to debit equity because those were your own shares. You had issued them previously where you credited equity, but this time around you are buying back the equity, so you are debiting the equity. You are reducing the shareholder spread, so you debit equity and credit the asset because you are disposing of it. An example of this situation is where we talk of treasury shares. Is that clear? Now, if the shares are going to be variable quantity of shares, then we're going to debit the financial asset and credit the asset which we have disposed of, and this is under the realm of IFRS 9. If, on the other hand, we are talking of, remember here, the receive, we are talking of the financial asset situation, right? We're talking of financial asset or equity situation, right? Where the shares were fixed, we debited equity, but where the shares were variable, we debited financial asset. But in this case now, here we are also talking of the liability or equity situation. If we are issuing fixed quantity of shares, then we are going to debit asset and credit equity. But if we are issuing variable quantity, we are going to debit the asset and credit the financial liability, right? And like I said, this comes to be an issue to be treated under share-based payments, where we are going to pay using fixed quantities of equities or shares. But if the shares are variable, then we're going to debit asset and credit financial liability, and this becomes an issue of IFRS 9. I-32 presentation. Financial instruments should be classified as either financial assets, financial liabilities, or equity. Compound instruments exhibit characteristics of both must be split into their debt and equity components. Remember the aspect of split accounting. Substance rather than legal form applies. For example, redeemable preference shares are a financial liability. Interest, dividends, loss, or gains relating to a financial instrument claimed as a liability are reported in the income statement, while distributions to holders of equity instruments are debited directly to equity in the statement of changes in equity. Offset of a financial asset and liability is only allowed where there is a legally enforceable right and the entity intends to settle net or simultaneously. This one usually comes in main exam situations where accountants are being pressurized to offset assets and liabilities with a certain motive, either to reduce the gearing, but such type of actions is not allowed unless there is some legal right to do so. Is that clear? Unless there is some legal right to do so. So it is an ethical issue. Usually comes on maybe question 2 in the ACCA SBR exam. Usually in question 2, where the examiner wants you to be, to exhibit your skills when it comes to ethical judgment. My people, let's now move to the classification of financial assets. We are going to start with debt instrument. I know when you hear of the words debt instrument, you start to think of liabilities. No, it doesn't work like that. Financial assets can also be equity instruments or debt instruments. That is, if we invest in equities of other companies, then that's an equity instrument, which will be a financial asset. Remember the definition of a financial asset. Sometimes we might be having a debt instrument in another entity. For example, we loan another entity. We'll be having a debt instrument in another entity. We lent them money. We gave out money on borrowing terms to another entity. So in that situation, we would be having a financial asset. So how do we account for that? We can account for these instruments, financial assets, either at fair value through P&L. This is the default category. That's the default category. You can categorize these instruments as fair value through P&L. By default, we are simply saying that if there is confusion as to whether we should account for them at amortized cost or at fair value through OCI, then you are allowed to just treat them as at fair value through P&L. All right. So all debt instruments, the intention mostly will be to sell in the short term. So the idea, when you then categorize them at fair value through P&L, your intention would be, to sell them in the shortest period of time. So in the short term, you intend to sell them. However, the debt instruments may be recognized at fair value through OCI. Here, the intention would be to both collect contractual cash flows and selling the financial assets. So you want to hold and then sell later. You want to hold whilst milking them. You hold them, and then at a certain stage in time, you sell them. What about at amortized cost? Here, you want to collect the contractual cash flows, that is the interest, principal, at redemption, interest and principal at redemption. This is when an entity has an intention to hold the instrument, the financial asset, until maturity. This is also known as the business model test. How long do you want to hold on to the financial asset? You want to hold on until it matures. That's your business model. You want to keep the asset until maturity, right? So that's the business model test. What about the contractual cash flows test? The contractual cash flows characteristics test. This one now says that for the classifications to be made, the timing of cash flows should be fixed. So in both the cases, the fair value through OCI and amortized cost, we should have some fixed timing in terms of cash flows. The cash flow timing should be predictable. There should be a certain period of time the investment should run. There are certain intervals which the investment is expected to be milked or to be remitting the interest income, right? So there is some steadfastness. So we are looking at the longer term. We are looking at the longer term in both the fair value through OCI or at amortized cost. We are looking at the longer term, but when we are talking of fair value through P&L, we are very speculative, very speculative. Let us look at this example. Purchased loan notes, 6% loan notes at 100 million per value. Then the discount in year 0, that's 12. Premium on redemption, 3.92. Transaction cost, maturity, 4 years. Market rate, 11%. Effective rate, 10%. Please note, 100 means at par value, as already been alluded to. The notes are at 100 par, right? Discount means below par value, right? They are being issued or they are being purchased below par, right? That is at 88 million, right? And on redemption, that's 3.92. Premium means above par value. The coupon rate is 6%. This is the amount of interest income that is going to be consistent. These are the contractual cash flows, all right, which are going to be the regular payments. So the 6% coupon rate is the how can I say, the interest payments. So that's 6 million at regular intervals, right? Then the coupon rate plus discount rate plus premium is equal to market rate minus transaction, which is equal to effective rate. That's the difference between market rate and effective rate is the transaction cost. This one could be, helpful if you want to be very innovative in your computations. Now, this computation is very important. Like I said, because we bought at a discount of 12 million, it means that we ended up buying assets at 88 pen at 88. So that is we're going to debit the financial asset 88 and credit bank. We bought them cheap at a discount. So this is the only amount we had to transfer, right? And then we have to capitalize the assets. We have to capitalize the asset by the 2 million, which is the transaction cost. Remember the transaction cost? That's the transaction cost, the 2 million. So we are going to debit the financial asset and credit, right? So this is to capitalize or to increase the value of the financial asset. That the financial asset is now recognized at 90 in the financial statements, which include the purchase value of the asset plus the transaction costs. Now, so we are going to then recognize this at amortized cost. Why? Because we have read it here that for debt instruments to be classified at amortized cost, it has to pass two tests. That is the business model test. Are you going to keep the asset for a short period or for a longer period? If it is for a longer period, then you go to the next test, the cash flow characteristics test, where the timing of cash flows should be fixed. So that is, then you have to come to the amortized cost, right? So the cash flows and as well as the intention is to collect the contractual cash flows, that is the interest and principal at redemption. So we are holding at amortized cost, and we are quite aware of the amortization table, where we have got the year, the balance brought forward, the interest income, 10% always effective rate on the balance brought down, that is effective rate on the 90, the opening balance, right? Right, and this is the column for balances brought down. So the effective interest rate is going to be charged on these figures. In year one, we're going to charge on 90, and that is 10% of 90, that's 9 million. And then these are the constant, they don't change, these ones. The interest, remember, this one is a financial asset, so we expect a receivable, an interest receivable, right? And the amortization becomes the effective interest minus the interest receivable. We come to the amortization, because the interest income is going to be reduced or to be amortized by the income receivable, which is the 6 million, and we come to 3, right? And this then means that our closing balance will be 93, which is 90 plus 9 minus 6, right? And we come to so under exam pressure, sometimes this column might not be, because sometimes it might confuse you. So if you simply say 99 minus 6, you have to come to 93. But if you want to be a little bit pedantic, you may as well have that one. But I don't think it is going to, give you many marks. But there are certain journals which will be assisted with the information. So it is also encouraged that you may keep the column as well, because certain journals, if you are not mathematically upright, you might find the column again is useful. So you may keep it, right? But just to understand that the amortization is just between the interest income and interest received, the actual money which was received. So the difference between the two. All right. So for example, in year one, we debit bank, which was the 6 million, with the 6 million which was received, and we also debited the financial asset with 3 million. Interest income was 9 million. So the 3 million here should be some balancing figure, but because we have got this column, simply means we are going to utilize to simply pick the figures from the column, the 3 million, and we slot it in the table. In year two, we are going to have the interest income charged on the opening balance, which was initially the closing balance 93 there. This is the same 93 we are talking about, and we charge 10% of this, and we get 9.3 minus the constant 6 million, which is the interest received, and we are going to have the amortization of 3.3. All right. So because we have got this table, right, It means that our figures are going to be troublesome to get. This is the bank interest, the interest receivable, and this is the financial asset capitalization. By debiting the financial asset, it simply means that we are bringing the financial asset, we are releasing, or we are systematically increasing the financial asset as we move towards maturity. So the 3.3 million is actually, part of the interest income, right? It's part of the interest income. However, this is the component that is yet to be paid. This was paid, the 6 million would have been paid, but this one is part of that income unpaid. So it is still a receivable. It is still a receivable. We need to receive it somewhere in the future, maybe on maturity. So it is going to, right? In year 3, we do the similar computations as in 1 and 2 up to year 4. In year 4 now, we still pay interest receivable of 6 million, right? As well as the 3.9, sorry, the 3.9 there. And if we add them up, we still come to that 9.99. We also have to pay the principal amount plus this is the principal plus the premium. Remember, there was a premium. The premium was 3.92. So this is 100 plus 3.92. So when we settle that, we're going to, it's not a payment, but this one is a receivable. Principal, receivable plus premium. Principal amount plus receivable. So we're going to debit the bank and credit the financial asset. Why are we crediting the financial asset? Because it has been redeemed. It has reached its maturity, right? So everything is paid. The outstanding, income, or the income unpaid has been paid. But the interest income has been paid as well in year 4. It is paid, including the premium. Now let's look at the financial liability side. The method used in the following example applies to deep discount bonds and other similar instruments, including zero coupon bonds. Debt issued for 400,000 nominal on 1 January 20x1 for proceeds of 315,526, redeemed for 400,000 per on 31 December 20x5. Right? So interest rate is about 4%. Effective interest rate 9.45%. So the interest rate here is actually the coupon rate. So the annual interest rate, remember, we're going to talk of the annual interest payments. We're talking of the coupon rate, which is 4%, multiplied by the par value, which is 400,000, multiplied by 5 years. This is 5 years. That is 2001 to 2005 December, 2001 January and 2005 December. So that's 5 years. We're talking of 5 years. That's 5 years. Sorry. So the annual interest payments that 8,000. Then deep discount bonds, that is 400,000 par value minus the proceeds, we get 84,474. So this is the amount of interest we are going to be charged. So we are not really going to be charged annually this amount, but this simply shows that for 5 years, this is actually a total 5-year total of interest payments. So in 5 years' time, the interest payments will amount to this figure. But initially, at inception, we are only going to recognize the proceeds because we have borrowed money. So we are recognizing the proceeds by debiting cash 315,526 and crediting liability 315,526. Now, here is the amortization table that brings everything into perspective. All right, so remember our opening balance is 315, 526. Okay, this should be the balance BD, that is 315, 526. So 9.5% of that amount should be the effective interest charge, which is, let me just try to prove that. So that's 315, 526 multiplied by 0.095. That's 29,975, as you can see, right? And we charge annually 4%. Excuse me. Annual interest, that's 4% by 400,000, which comes to 16,000. So this is the 16,000. So we say 29,975 minus the payment. This is actually the payment, which is going to be constant throughout the interest payments. 16, 16, 16, 16, 16. This is constant figure, right? So it reduces the finance cost from 29 to that amount. All right. So this simply means that the closing liability is going to be 329,501, and that becomes the opening balance. And we charge again 9.5% on that amount. So we are going to say 329,501 multiplied by 0.095. So we get 31,303. Then we deduct 16,000. We arrive at that amount. All right. And we then arrive at this. All right. Like I said, to get these figures, you just have to say the opening balance plus the effective interest charge, which is this amount, minus the amounts paid, and you get these values. These ones, like I said, you may try to ignore, but they are very important because these are actually the remaining expenses after we treat the interest charge less the interest paid, and we get these amounts. They are very, very important because they are net expense, the net expense figures. So in the examination, you will be led by the examiner himself. So here we are told that the debt will be redeemed for 400,000, that is at par on 31 December 2025. So the moment you reach the 400,000 mark there, it simply means that you have reached the redemption value. So to redeem this, since it was a liability, we need to debit the liability, isn't it? Debit liability 400,000, and we redeem the liability by paying bank. So crediting bank 400,000, right? Of course, another payment. This one is redeeming the principal amount. Let us again look at this example where we have got a loan note, a 5% loan note, and we now know we are now comfortable with these figures. This is the coupon, the constant amount to be paid every year, and which is the 5% of the nominal value of 100. The discount near 0. Okay, we have issued the loan notes at a discount of 7 million, right? So which means that's 93. This is why we are going to only receive 93. We are receiving 93, but we need to repay. Okay, we are going to repay 100 million. Sometimes there is a premium. Like for example, it now becomes 103.24 million, right? So we're going to debit the bank 93 and credit the financial liability. Then we also have to debit the financial liability with the transaction costs. We need to capitalize it with the transaction cost of 3 million, right, and credit the bank. Therefore, this will result in financial liability being measured at 93 minus 3, which comes to 90. This is different from the impact of capitalization in an asset situation. In an asset situation, the capitalization is going to increase the asset value, but here it is going to reduce. It is going to reduce the liability. Are we together? It is now going to reduce the liability. So we may, for now, ignore the market rate. Okay, but if the question is about convertible loan notes, you need to pay careful attention to that figure, that percentage. Anyway, let's proceed. So the maturity of this loan is 3 years. So our amortization table should be as follows. The balance BD is 90, as we have computed here. Now, the interest expense, which is the effective rate, that is 10% of 90 becomes 9, and the interest, which is based on the coupon rate, which was 5%, multiplied by 100 million, and we come to we come to 5 million. Good. Now 9 minus 5, that's 4, which is the amortization, and we come to that is 94. And like I said, 94 is found by 90 plus 9, that's 99, minus 5, 94. Then we take the 94 to be the opening balance in year 2. That is being increased by the 10%, that is 9.4, and reduced by the payment, which is 5, and we arrive at 4.4, and we get the 98.4. And 98.4, like I said, that's 94 plus 9.4 minus 5, we get the 98.4. We do the same until we reach this point. We are saying 98.4 multiplied by 10%, and we get 9.84, right? Minus the 5%, the interest paid, we get 4. That one. But here, to get this figure, you need to do the mathematics. We are saying 98.4 plus 9.84 minus 5, and you get your figure there. But the figure you are going to get is not necessarily going to be this one. So this is why I always say, at the end of the period, that is the maturity date, at the maturity date, always get all the information from the examiner. This is why I indicated that this is the par value plus the premium, because the examiner had said that there is going to be premium on redemption, which is 3.24, and the loan notes, this one is the principal amount. So that's principal plus premium there, the par value plus the premium. So you might be worried as to why the figures are always going to come to the par value plus the premium without leaving any remainders and so forth. Now, the trick is on the effective interest rate. If the effective interest rate is the right rate, then everything is going to come to the par value plus or minus any discount that is going to be there. Anyway, but the permutations or the computation of the effective interest rate is not really so far, because it will be more of a financial management examination than a financial reporting one. But it is the effective interest rate that is going to ensure that if you have done all your computations properly, you need to arrive at the appropriate amount there. that leaves no remainder and except some few roundings as well. So, ladies and gentlemen, these are the accounting entries we expect to see. All right, so initially we are going to debit the finance cost of 9 million. How did we find the 9 million? If you come here, you will see that the 9 million was 10% of 90. So we are going to debit the finance cost. Remember, finance cost is a product of the effective interest rate multiplied by the balance bidding, all right? And so this is this expense. Then we credit the bank with the the constant interest payments. Remember the coupon rates, okay, the coupon amounts, the interest payments, all right, and then the amortization of the financial liability, and this amortization increases gradually, and is the maturity year. By the of maturity, it would have reached this amount. Annually, the finance expense, which is the 10% of the of the balance brought forward, which is the effective interest charge, which is an expense in the statement of profit or loss, right? And finally, to clear the liability, we need to debit the liability, which includes both the par value, as well as the amount, and credit bank would have cleared the liability. Now, let us look at amortized costs example, where we have got a convertible loan note, which is also a compound financial instrument. And here, what works is what is called split accounting. So a debt instrument has both debt and equity component. So we have got 6% convertible loan notes at 100 million per, discount 4 million, premium or redemption 3, transaction cost 1, maturity 3 years, market rate 9%, effective rate 9.38, convertible into shares. How many shares? 25 million. Compound financial instruments for financial liability, is split into a financial liability and an equity. So we need to have the present value of all cash flows discounted at market rate. This is when it comes to convertible loans, that's when we need to use the market rate to do the discount, right? So the market rate is going to be applied to discount the cash flows to present values. And when you do that, the balancing figure is going to be the equity component. So here we want to determine the present value of the instrument, the PV. This is the PV, the present value. So we've got items, the interest expense, for both years, for all the years, the 3 years, is going to be the 6%, which is the coupon rate. Remember, the coupon rate 6%, right? So that's the cash flow. We're going to discount at market rate. We discount at market rate of 9%. Then the redemption value, remember, we are redeeming at $3 premium. So it comes to 103. And these are the discount factors at 9%, which is these are the annuity factors. You need to be able to compute the annuity factors. All right. Sometimes the examiners might expect you to come up with the computation of annuity factors and discount factors. They are different. You need to be able to come up with those figures as swiftly as possible, because there won't be any time in the examination. So now we have determined the market value of the instrument, which is 94.702. Yes, the next step. So in year 0, you're going to debit bank with 96, because this is the amount, right? And you need then to, because you are borrowing money, remember, you are borrowing money, okay? So you are borrowing at a discount of 4, so you're only going to receive 96. However, with the transaction cost, then it will be as well lessened by that amount. So we receive 96. However, the present value, the present value was 94.702. So we need to split that amount. We need to split the 96, which was received in the bank, that when we received it, it has to be accounted both in liability and equity. So for the liability, we're going to use the present value of the instrument, which was this one, and then this one becomes the balancing figure. The other amount becomes the balancing figure. Now, capitalizing the transaction cost on the same day, this is done by proportionately sharing the transaction cost with respect to the liability and equity amounts. Remember, the transaction cost was 1 million, if I'm not mistaken. Yes, it was 1 million. So it has to be, that's, we need to use this ratio. This is the ratio for allocating the transaction cost. So that's 94.7 over the total of 94.7 and 1.3, which is 96. So for equity, remember, we are debiting equity and debiting the liability as well with the allocation. Remember, at the bank, we are only paying the transaction cost of 1 million in total, but the payment is to be split. The payment is to be split between the equity and liability. So how do we do the splitting? We just do them around their ratio, right? So for the equity, we are using the 1.3 over 96 multiplied by 1 million, and we get that one. Then for the financial liability, we also do the 94.7 over 96 multiplied by 1 million, and we come to that. This means in the SP, in this position, the value of the financial liability will be 94.7 minus 0.986, which is the amount we have just determined there, which is about to that amount. And the equity will be 1.3, which is this amount we have obtained there, minus the reallocated transaction costs, and we come to that one. Now, let's talk of the amortization schedule. This is now the amortization for the liability, the new liability there after the treatment of transaction costs. Is that clear? Now, for this one, it shouldn't be a problem. Just follow the same thing. And here we are now using our traditional effective rate, which is 9.38 as given. So this is the traditional rate we have been using so far, and this is lessened by the actual interest paid, and these ones are constant figures. Ladies and gentlemen, these ones are constant figures. Okay, and we come to the amortization and all these other figures, right? And we arrive at 103, which is equivalent to what was said, because the premium on redemption was 3. So 3 plus 10 plus 100 comes to 103. As simple as that, isn't it? Now the counterpart can choose to have either shares or cash. If shares, the accounting entry would be, we need to debit the financial liability 103, debit equity option 1.28, credit share capital, that is $1 shares, that is 25 million, and credit share premium 79. Remember, why 25 million? We were told that the convertible loan notes could be converted into 25 million shares, and the shares, the nominal value is $1 normally it's $1. So this is why we are saying they are going to be 25 million ordinary shares plus the share premium, which is the amount that is the market value of. So this, remember, is the redemption value of the debt instrument. Remember the redemption value, which was 103. Excuse me, 103. So we then have to work it out here, right? So if we convert into shares, it means that the equity capital should add up to 103. However, in this 103, there are 25 million $1 shares. Okay, 25 million $1 shares, which is the nominal value of the shares, the ordinary share capital, the share capital, and the remainder becomes the share premium. And this should be 79.28. 79.28. Actually, this share premium and share capital should be shared between 103, between the total of 103 and this comes to, let me just use my connection here. It's 103 plus 1.28, that's 104.28. That's 104.28. Sorry for that. 104.28. So 25, we add up 25 plus 79.28, that's 104. All right, good. I'm sorry for that. This should be the treatment if we are going for conversion. What about if we want cash? If they ask for cash, the entry should be as usual. We are debiting the financial liability because we are clearing the liability, and also we are closing the equity. We are reducing the equities, right? So, or we are de-recognizing the equity. And then we are going to credit the bank with 103, right? We are crediting the bank with 103, and we are crediting retained earnings, which is a gain. As we reduced our equity, we made a gain. That is a gain. No, there's been a gain because if they want cash, we are only liable for 103 million only, and the remainder is directly recognized in retained earnings as a gain on the equity option. If they want cash, it means their equity option has lapsed and it becomes our gain. Any gain or loss on equity instruments is recognized directly in retained earnings, which is part of equity. Please bear this in mind. Now, let's talk of reclassification of these financial instruments, right? By reclassification, we are simply saying that an instrument which was maybe originally recognized at fair value through profit and loss might end up being moved to fair value through other comprehensive income, or to be held at amortized cost, or vice versa, and something like that. Now, equity and debt, fair value through profit or loss. Equity instrument of another entity cannot be reclassified. This means, for example, we cannot take equity from P&L to other comprehensive income. Once an equity instrument has been classified, we cannot reclassify it. Only debt instrument of another entity can be reclassified. So only debt can actually be, moved from amortized to fair value through other comprehensive income, or to fair value through P&L. Now, amortized cost to fair value. Amortized cost to fair value, that is movement from amortized cost to either fair value through P&L or fair value through other comprehensive income. We have just seen that debt can manage to move from amortized to any of the fair values, either through P&L or other comprehensive income. So this means whatever balance brought forward, we have to remeasure at fair value, and obviously gains or losses may arise. The gains or losses will be recognized either in the P&L or OCI, depending on the category chosen. If we have chosen to recognize the instrument, the debt instrument, into fair value through other comprehensive income, then it means that the gains or losses will be recognized in the OCI. If we have chosen for fair value through P&L, then the gains and losses have to be accounted for in the P&L. So you need to remeasure the financial asset to its fair value with gains or losses recorded according to the category. Now, fair value. Now, if you want then to do the reverse order from fair value to amortized cost, then the last fair value will be deemed or assumed to be the amortized cost. Reclassification is only allowed when there is a change in the business model or intention, that is short or long-term intention. Before you decide to reclassify, have we come to a decision that we are moving from the short term to the longer term? If we are still at short term and the timing is still unpredictable, then it simply means that amortized cost cannot apply. How do we de-recognize a financial asset? Remember, it is the right to receive cash. How do we recognize the right to receive cash? Either we have to exercise the right, we need to transfer, or we just have to let the right lapse. So if we exercise, we then have to debit the bank. That is, we receive the cash and credit the financial asset, which means because the moment we receive the actual cash, then there's no more financial asset. So we're going to debit bank and credit the financial asset. What about if we transfer? We can transfer the asset. Here we need to assess the risks and rewards to see if they have been transferred. If the risks and rewards have been transferred, then we're going to debit the bank and credit the financial asset. If the risks and rewards are not transferred, we're going to debit the bank and credit financial liability. But now, if we allow the right to lapse, then we're going to debit P&L expense or loss and credit financial asset. Let's look at this de-recognition example in the factoring situation. Now, factoring, bad debt risk to factor. We have transferred the bad debt risk to a factor in a non-recourse factoring situation. So we need to understand what non-recourse factoring is. We are all on the same page when it comes to understanding the concept of factoring. A factor is some form of an agent who is there to help us clear our receivables ledger. So we can hire these experts who have got all the talent and skill to pursue debtors. So we go to them and say, please, we have got this receivables ledger. Can you please track our receivables? And they can do that one with ease. That's their core competence. So in a situation where there is no recourse, we are simply saying that once we have given the ledger to the factor, if he fails to pursue those people, that's his own baby. The moment we give them the ledger to say maybe the ledger had 100 million, let me just try to write something, had 100 million receivables. Then the factor says, I'm going to give you 80 million. And the rest, the 20 million, that's his profit. He pursues the debtors, at his own peril. If he fails to recover anything, he's not going to come back to us and say, please refund me. There is no recourse. No recourse. So in that situation, we would have transferred all the risks and rewards. We're not going to get the reward. The 20 million gain he's going to enjoy, that's not going to be part of us, because we have relinquished all the rights over those debts, over those right. So that's the non-recourse situation. So in that case, we are allowed to de-recognize all the receivables. We are de-recognizing, so we are crediting the receivables and debiting the bank the money which you would have given us, and we're also debiting his fees, the charges. Is that clear? Good. So we are de-recognizing all the receivables as pertaining to the. What about in a factoring situation where the bad debt risk is still borne by us? If the factor pursues and fails to recover certain debts, he is going to pounce on us. So in that case, we are only going to debit bank and credit a financial liability. Why a financial liability? Because there is potential that there is going to be some recourse. So here the risks and rewards have not been transferred. So we recognize a liability as we may be required to repay it to the factor. So it's some sort of provision. However, when the factor receives cash from the customers, the following entry is applicable. We're going to debit P&L, that is the factor's fee, debit the financial liability we would have opened to recognize the liability. So we're going to debit it to de-recognize. Then we are going to credit receivables to de-recognize the financial asset receivables. Sure, we have cleared this, confusing table. Is that clear, guys? So, in the world of financial instruments, there might be situations where you enter into a contract where you sell the financial instruments, for example, the financial asset. You sell the financial asset to another party, but you still have got, the obligation to buy them back. If there is a buyback price and the buyback price is fixed and the risks and rewards are not transferred, right? You are going to buy at a fixed price, but the risks and rewards are not transferred. Then we treat that one as a financing or loan agreement or loan arrangement. It's a financing or loan arrangement. So what do you have to do? You need to debit the bank because you have sold something, you have received, but the sale is creating a liability because all the risks and rewards associated with those assets is still borne by you. It's not transferred. So you debit bank and credit financial liability. At the end of the year, you need to account for the finance cost. So you debit the finance cost expense and credit the financial liability. So we are increasing the financial liability with the finance cost. And when you purchase the asset back, then we are going to clear the liability. We are closing the liability by debiting liability and crediting bank. As simple as that. Then, in another situation, the buyback is going to be at fair value, which means the risks and rewards are transferred the moment you sell it. So the moment you sell it, you're going to debit the bank and credit the financial asset because you are de-recognizing it because the risks and rewards have been transferred to the buyer. Then when you want to purchase it back, when you purchase it back, you are debiting the financial asset and crediting the bank. As simple as that. So when you'll be reading the scenarios, please understand what will be going on. How do you, let me just say, when do you de-recognize financial liabilities? An entity shall remove a financial liability or a part of a financial liability from its statement of financial position when and only when it is extinguished or it is cleared. When the obligation specified in the contract is discharged or cancelled or expires. We don't just have to wake up and see those financial liabilities disappearing. No, there should be some valid explanations as to what would have happened. So the standard doesn't want an extinguishing except when and removal except when and only when it is extinguished, that is when the obligation specified in the contract is discharged, that is the counterparty performed his obligations or cancelled or it expired. The difference between the carrying amount of a financial liability or part of the financial liability extinguished or transferred to another party and the consideration paid, including any non-cash assets transferred or liabilities assumed, shall be recognized in profit or loss. Let's move on to another issue where we talk of expected credit loss model, ECLM, that is impairment. Let's talk of impairment. So, for the financial asset, there are 3 stages which should be observed. There is stage 1, that is the performing stage. Here, the financial assets who are expected to perform in line with contract. No loss is expected in stage 1. The financial asset is performing. Then stage 2, credit risk significantly increased. Credit risk increases such that credit quality is not low risk. Then in third stage, this is a stage where the credit has actually been impaired. The default event has occurred. Example, the debtor has actually gone bankrupt or has been offered for liquidation. So that's where we can actually say the credit is being impaired. What about the loss allowance? 12 months expected credit losses. At the time of initial recognition, recognize the expected loss due to events that are possible within 12 months after the reporting date. Stage 2, lifetime expected credit losses. Here we need the present value of losses that arise if a borrower defaults on their obligations throughout the life of the financial instrument. Then lifetime expected credit losses. Stage 3, present value of losses that have actually arisen when a borrower defaults on the obligation throughout the life of the financial instrument. So the difference between the two is that here we are assuming, but in stage 3, actually something would have happened. The borrower would have defaulted throughout the life of the financial instrument. However, here we are just doing some permutations. We are assuming. Now, when it comes to interest revenue, stage 1 on gross carrying amount, we just have to use the effective rate multiplied by gross carrying amount. Stage 2 on gross carrying amount, effective rate multiplied by gross carrying amount. Then on stage 3 on net carrying amount, effective rate multiplied by net carrying amount. In terms of interest revenue, the balance brought forward should be an amount before factoring any credit losses for instruments in stage 1 and 2. That is why it's stated above, effective interest rate multiplied by gross amount in both stages. But for stage 3, the balance should be amortized after deducting the loss allowance. Something else now, hedging. Hedging. What is to hedge? Is to put some boundary fence to protect the domestic animals from wild animals, isn't it? So some sort of, covering, some sort of protection, some boundary fence, sort of. So hedging for accounting purposes means designating one or more hedging instruments so that their change in fair value is an offset in whole or in part to the change in fair value or cash flows of a hedged item. Hedging instruments. A hedging instrument is a designated derivative or, in limited circumstances, another financial asset or liability whose fair value or cash flows are expected to offset changes in the fair value or cash flows of a designated hedged item. A hedged item is an asset, liability, firm commitment of forecasted future transaction that exposes the entity to risk of changes in fair value or changes in future cash flows, and that is designated as being hedged. How do you account for hedging? Hedge accounting recognizes the offsetting effect on profit or loss of changes in the fair values of the hedging instrument and the hedged item. Hedging relationships are of 3 types. There is what is called fair value hedge, a hedge of the exposure to changes in fair value of a recognized asset or liability, or an unrecognized firm commitment, or an identified portion of such an asset, liability, or firm commitment that is attributable to a particular risk and could affect profit or loss. So in fair value hedging, obviously the profit or loss is going to be affected. What about in cash flow hedge? A hedge of the exposure to the variability in cash flows that is attributable to a particular risk associated with a recognized asset or liability, such as all or some future interest payments on variable rate debt, or a highly probable forecast transaction, and could as well affect profit or loss. Then lastly, hedge of a net investment in a foreign operation. This one is as defined in IAS 21, right? Designation and documentation must be formalized at the inception of the hedging relationship. So the following have to be formalized, that have to be documented at the inception of the hedging relationship, that is the hedging relationship itself, all right, with the counterparty and with the other party. Risk management strategy and objective for undertaking the hedge, the hedged item and hedging instrument, how hedge effectiveness will be assessed. Everything should be clear from the onset. All three hedge effectiveness requirements met. So these requirements have to be met. An economic relationship exists between the hedged item and hedging instruments. It should be an economic relationship, something that is viable business-wise. Credit risk does not dominate changes in value. So credit risk should not be dominant towards or should not be contributive to the changes in the value of the hedged item. The hedge ratio is the same for both the hedging relationship and quantity of the hedged item actually hedged and the quantity of the hedging instrument used to hedge it. I hope there is going to be some example very soon. Accounting treatment of hedging. Now, fair value hedge, it is the exposure to changes in fair value of recognized asset or liabilities. The accounting treatment here is that the hedge instrument gain or loss will be charged to profit or loss unless hedge item is equity instrument measured at fair value through OCI. Hedge item gain or loss will be charged to profit and loss unless hedge item is equity instrument at fair value through OCI, then recognized in OCI. All right. So both the hedging instrument and the hedge item should be treated separately. They've got separate treatment. However, in both cases, the fair value, the gain or loss should be charged to the P&L unless the instruments or the hedged items have been measured at fair value through OCI. Cash flow hedge. Cash flow hedge. It is a hedge of the exposure to variability in cash flows. It is attributable to cash flows that are attributable to particular risk associated with the recognized asset or liability or a high probable forecast transaction. It could affect profit or loss. Here's the accounting treatment. Hedge instrument. Gain or loss on a hedge instrument that is determined to be an effective hedge must be recognized in OCI. Will become paid reserve in SOCI, that is statement of changes in equity, and ineffective portion will be charged to profit or loss, the ineffective portion of the hedge, and effective portion separate reserve. Actually, here this is separate reserve. All right, that is the effective portion will be reclassified to P&L when cash flow is expected to effect profit or loss. If non-financial asset recognized due to hedge item, then a reserve can be adjusted in initial cost of non-financial asset. Perfect hedging. In carrying out hedging, companies always try to make their hedges perfect. They try to make their hedges perfect. This means that they try to set up the deal such that if they lose a dollar on the primary risk, then they win $1 back on the derivative. In practice, a hedge rarely works out as perfect, but in exam questions, hedges are often perfect. In the exam, please expect them to be perfect. Zero cost. In real life, companies almost always have to pay for the derivative bet. There is usually an initial outlay to enter the bet. However, the initial outlay is often too small that it is negligible. But in an exam, the derivative bet is often literally zero cost. Let us look at this example, Bacana PLC. The above company, Bacana obvious, plans to buy a massive consignment of coffee shortly after the current year. After the current year end, when the coffee ripens and comes to the market, the bulk purchase has an expected cost of 500 million based on current market prices. However, freak weather conditions and reports of global warming have caused the management to fear that coffee prices will rise and that the price of the bulk purchase will be higher when the crop of coffee beans comes to the market. So the company enters into a perfect hedge instrument derivative based on the price of coffee. The instrument is a bet on the price of coffee rising and pays 1 million for every 1 million that the cost of the consignment rises above 500. The cost of the derivative is zero because the other party to the bet believes that the price of the coffee will fall. The other party is looking at the same information but believes that global warming will increase the volume of coffee being produced at the next harvest. By the year end, the value of the consignment of coffee has risen to 530 million, and this is the price at which the coffee is purchased shortly after the new year start. So the derivative is closed out by the other party by paying 30 million to clear the liability. Clearly, Bacana PLC were right about the coffee prices and so won the bet. Explain the financial statement effect of the above using journals to show the changes for both the years. So, we are told of the betting that is taking place. Okay, this company is trying to enter into a hedging transaction using derivatives. All right, so they've entered into a perfect hedge instrument derivative, and this is based on the price of coffee. Now, the instrument is a bet on the price of coffee rising and pays 1 million for every 1 million that the cost of the consignment rises above 500 million. The cost of the derivative is considered zero. So if it is considered zero, say obviously we're going to debit zero on the derivative and crediting zero as the opening journal, right? The cost is negligible. Remember, there's cost principle, the zero cost principle. All right. Now, at the end of the year, we are told that at the end of the year, coffee has risen to 530. And remember, this company was paying 1 million for every $1 rise in cost. So if the cost is now 530 at the end of the year, so therefore the full 30 million has, the cost there from 500. Remember here it was 500. Expected to be 500. However, they entered into that bet that if the cost rise from 500, then every 1 million rise was going to be compensated by a 1 million payout, right? So the derivative is closed by the other party by paying 30 million, which is the difference, right? 530 and 500 there to clear the. All right, so coffee has risen to 530, so we are going to debit the derivative and credit the hedge reserve. All right, so the derivative, actually the derivative cost 30 million, right? And crediting the hedge reserve. Now, when we are now closing out after executing the transaction, by the end of the market value, by the consignment of coffee has risen to 530, and this is the price at which the coffee is purchased shortly after the new year. So they purchased it at 530. So the derivative is closed out by the other party by paying 30 million to clear their liability, right? So clearly, Bakana PLC were right about coffee prices, and so they won the bet. So how do we close out now? So since we bought the consignment at 530, we are going to the inventory with 530 and credit the bank 530. We also have to debit bank because we received 30 million and credit the derivative. Remember, we're going to credit the derivative to recognize the derivative which we would have recognized then, right? So we need to close out that. So the bank is receiving 30 million and we are crediting the derivative to derecognize the derivative, and also we are closing out the hedge reserve because we had created the reserve, but now we want to derecognize it because we are closing the transaction, we are closing the hedge in essence. So we are also debiting the reserve to close it and also crediting the inventory with that amount. So if we are crediting the inventory, this simply means that the resultant inventory will be $500. So the hedging would have, assisted, we would have protected because we were anticipating the cost to be 500. However, because we feared that prices might change, we entered into a bet, all right? So the bet we then entered into a perfect bet by entering into a perfect hedge instrument, which was that 30 million. So when the prices rise, we were actually found to be on the on the right side of betting, and we win. So it means that 30 million should come into our money, into our pockets, because we are the people who have won the betting, isn't it? So this is why we are saying that we as well have to receive the 30 million, right? And at the same time, the cost of inventory is not going to be 530, but in essence, because we have got, when we close out, we then have to credit inventory, that is to amount with the 30 million. Is that clear? So the other way to look at this particular transaction is that while the inventory might be recognized at 530, okay, the inventory will be recognized at 530 million. The 30 million which the other party paid us, the inflow, the 30 million should be a gain, isn't it? Should actually be a gain. So in essence, the economic exposure would have been only 500. I mean, the cash outflow exposure should only amount to 500 million because this would have been an inflow. This is an inflow, which should be a gain in a way because the other party who was predicting that coffee prices would fall was found to be on the wrong side, isn't it? So he is the one who is to pay us. Is that clear? Now let's talk more about these derivatives. A derivative is a financial instrument with the following characteristics. It does not have its own price. Rather, its price is determined from some or other underlying instrument. Initial investment is very low, that is zero. Remember the zero cost, principle. Settled at a lower date. Examples of derivatives include forward contracts, futures, options, and swaps. How to determine a derivative contract? So you need to look at the contract by reading the scenario. You need to ask yourself, is it involving a financial instrument? Are financial instruments involved? If they're involved, then it's most likely that the contract in question includes a derivative. Then, if a contract is a non-financial instrument, then Ask yourself, does it involve goods, or let me just say, does it involve settlement in goods or in cash? If it involves goods, then it is non-derivative and it should be accounted for as a onerous contract where a provision for the loss is met. But if the settlement is in cash, then it should be a derivative. Let us look at the following example. On 1 September 2026, Masaba Limited entered into a fixed price forward contract to purchase 2,000 tons of copper at 400 euros per ton. The local currency is dollar. So in Masamba's jurisdiction, the local currency is the dollar. The purchase price, this purchase is in accordance with its normal usage requirements. They normally procure 2,000 tons. The contract allows Masamba Limited to take delivery of the copper on 31 August 2028, or to pay or receive net settlement in cash based upon the change in the value of copper, but not on the change in the foreign currency exchange rate. Masamba has not settled similar contracts in the past before delivery of the copper, so this was something new to them, right? Masamba does not have a foreign currency contract to hedge against any risk caused by any movement in the dollar-euro exchange rate, and has paid a non-refundable deposit of 100,000 euros at 1 September 2026. The following exchange rates are relevant. So 1 September 26, when this amount was, the non-refundable deposit was paid, the euro-dollar exchange rate was 2 euro as to dollar, right? 2 euro per dollar. But now on 31 August 27, it was now 1.75 euros per dollar. So in essence, okay, the euro was appreciating because we were now able to buy a few euros with a dollar. But previously we could buy 2 euros per dollar. But now we are only buying 1.75. So the euro was appreciating in value. There had been no change in the contract price of copper at 31 August 2027, and it is felt that the decline in the dollar-euro exchange rate is unlikely to be reversed. So there is a view that the dollar is going to fall. The directors of Masamba would like to know how to account for the above contract at 31 August 2027 and whether it is within the scope of IFRS 9 financial instruments, together with any implications of the change in the dollar-euro exchange rate. 7 marks. So this is the analysis. Remember, copper is a non-financial instrument. It is not a derivative. It is a good. Normal usage requirements indicate the contract were to be settled in goods. There was where they said that this purchase is in accordance with its normal usage requirements. So the contract is for goods, settled in goods. Also, there is a supporting point that Masamba is not settled similar contracts in the past before delivery of the copper. So settlement is in goods. When the goods are delivered, that's when we are going to settle the contract. So it is contract that is being settled in goods. Therefore, this is a non-derivative contract and therefore a non-financial instrument case. And we have to apply IAS 37 onerous contract. The contract was of 2,000 tons of copper multiplied by 400 euro. This comes to 800,000 minus the non-refundable deposit, which is a cost that is going to be incurred regardless of any gain which is going to be made. So that's something synonymous with onerous contracts, isn't it? So this comes to 700,000 divided by the exchange rate of the day, which was 2 euro per dollar. So this comes to $350,000. However, as at 31 August 27, the rate has changed and the liability was now 700,000 divided by 1.75, which means we are now going to pay more dollars. Initially, we were going to pay 350,000 only, but now 400,000, giving a difference, which is a loss of 50,000. And the 50,000 should actually be a provision for a onerous contract. Provision for a onerous contract. Accounting treatment for derivatives, fair value through profit or loss. Initial measurement, we measure them at fair value. Subsequent measurement, fair value, and gain or loss will be charged to P&L. Derivative standing at gain, that's a financial asset. Derivative standing at a loss, that's a financial liability. Embedded derivatives. An embedded derivative is a component of a hybrid contract that also includes a non-derivative host, with the effect that some of the cash flows of the combined instrument vary in a way similar to a standalone derivative. What are host contracts? Host contracts are the contracts in which derivative contracts are embedded. Examples include a lease contract, a debt or equity instrument, an insurance contract, a sale or purchase contract, a construction contract. A derivative that is attached to a financial instrument but is contractually transferable independently of that instrument or has a different counterpart is not an embedded derivative but a separate financial instrument. What is the measurement? Hybrid contracts with financial asset hosts. If a hybrid contract contains a host that is an asset within the scope of this IFRS, an entity shall apply the measurement rules to the entire hybrid contract that is recognized at fair value through P&L. For example, investment in convertible loan, investment in bond, where interest rates vary with gold prices. Other hybrid contracts. If host contract is a financial liability or non-financial contract, for example, issue of convertible loan, lease or construction contract in foreign currency, the criteria, if met, separation required. Economic characteristics should be different. Host contract and derivative. Host contract should be measured at fair value through P&L. Embedded derivative should meet the definition of standalone derivative. What are the disclosure requirements in terms of IFRS 7? IFRS 7, because that's the standard that talks of the extensive disclosures related to financial instruments. The objective of IFRS 7 are that the standard requires entities to provide disclosures in their financial statements that enable users to evaluate the significance of financial instruments for the entity's financial position and performance, the nature and extent of risks arising from financial instruments to which the entity is exposed during the period and at the reporting date, and how the entity manages those risks. Classes of financial instruments and level of disclosures. IFRS 7 requires that certain disclosures should be given by class of financial instruments. The classes of financial instruments that will be disclosed should be appropriate to the nature of the information disclosed and should take into account the characteristics of those financial instruments. An entity should provide sufficient information to permit reconciliation to the line items presented in the statement of financial position. The statement of financial position. Financial assets measured at fair value through profit and loss, showing separately those held for trading and those designated at initial recognition. So this is part of the disclosure. So actually the presentation. We are simply saying that in the SFP, financial assets measured at fair value through P&L have to be presented, showing separately those held for trading and those designated at initial recognition. So there are those who are designated at initial recognition as to be measured or as to be recognized at fair value through profit and loss, and those which are held solely for trading, right? So they should be shown separately. Special disclosures about financial assets and financial liabilities designated to be measured at fair value through profit and loss, including disclosures about credit risk and market risk, changes fair values attributable to these risks, and methods of measurement should also be disclosed or should also be made. Reclassifications of financial instruments from one category to another, that is from fair value to amortized cost or vice versa, should also be disclosed. Information about financial assets pledged as collateral and about financial or non-financial assets held as collateral should also be disclosed. Another disclosure is the reconciliation of the allowance account for credit losses, that is bad debts, by class of financial assets. Information about compound financial instruments with multiple embedded derivatives. Lastly, breaches of terms of loan agreements. All these have to be disclosed. What about the statement of profit or loss and other comprehensive income? Statement of financial performance, remember, IFRS 18. Items of income, expenses, gains, and losses with separate disclosure of gains and losses from financial assets measured at fair value through P&L, showing separately those held for trading and those designated at initial recognition. So extensive disclosures in the presentation are paramount. Total interest income and total interest expense for those financial instruments that are not measured at fair value through profit and loss, right? So their interest income should be disclosed. Fee income expense, amount of impairment losses by class of financial assets, interest income on impaired financial assets. All these disclosures are required. Before we call it quits, guys, there are about 2, if not 3 questions I want to do with you. So please hang on. So guys, let us look at this question. A company has issued preference shares. Preference dividends are only required to be paid when dividends are paid to the ordinary shareholders. The preference shares contain a call option. What is a call option? An option, or let me just say a right, but not obligation. It is a right, but not obligation to buy. So the preference shares contain a call option enabling the company to redeem the shares if it so wishes, if it so chooses. So is this a debt or equity transaction? If in an examination this type of question or a similar question comes, you need to be organized, because let's say the examiner said they are, you then have to at least define what debt is and what an equity is. So what is debt? We say that debt is actually the obligation to deliver cash or another financial asset, obligation to deliver cash. You need not to be so sophisticated like to come up with the definitions word for word as they are from the standard. You just have to be reasonable. Yes, if you manage to come up with what is written in the standard, that's good for you. So obligation to deliver cash or some other financial asset, right? Now, equity is the residual interest in an entity's assets and so forth. That type of definition will help you to create a good case. Then you ask yourself, was there some obligation? You can see that there is no obligation to pay dividends. So no obligation to pay dividends. If you are just somebody who is not paying attention to detail, you might simply rush and say, oh, preference shares and they are redeemable, therefore this is a liability. But the redemption here is not forced. It is subject to the company's wishes, subject to the company's choice. The dividends are not forced. It only pays them when it so desires. So there is no obligation. All right. So what then comes next? You may talk of the core option. Yeah, you need to talk about that. The core option is again a right but not obligation to redeem the shares. So there is actually no obligation. So these preference shares should be treated as equity. In an equity situation, the ordinary shareholders are not mandated to receive a dividend. Managers are not forced to pay them a dividend. Do you understand? So such preference shares are considered equity instruments. Let us look at this other example. Beautiful people, this is the last. Okay, I'm no longer taking your time anymore. All right, but this question is more like it. Ruvingo has issued preference shares that contain a put option, enabling the shareholders to require Rubingo to redeem the shares at any time at the original amount subscribed plus an annual compound of 5% less any dividends that may have been paid. All right. So this is the case. So the examiner wants to know if this is debt or equity. Advise him. So like I said, 4 marks. It's better, to find something to write, but it's good even for consultant purposes, for your consultant skills, to be able to define debt and equity. All right, so that you create your platform as you answer the question. So that given from the definition of debt or from the definition of equity, this transaction is equity or this transaction is debt. All right. So the definition itself, you need to start with the definition, define debt and equity. Number two, talk of the put option. The put option here is creates an obligation on the part of the company. So the company is to redeem the shares at the whims and call of the shareholders. So there is an obligation. If there is an obligation, what next? So therefore, you need to conclude that this is debt. And if it is debt, therefore, interest at 5% should be charged. Then you pocket your 4 marks, isn't it? Less any dividend that might have been paid. So, guys, that is it. Financial instruments, we have covered it. Much of the things will be perfected during the revision phase as we'll be tackling past exam questions. So do not worry for now. For now, just capture these things, put it closer to your hearts, revise, replay the videos until they start to make sense in your heads. Thank you so much, guys. You're so good. You're wonderful people. If you're new to this channel, please subscribe. Don't forget to like, share, and comment. Make them viral so that other people benefit. See you guys in the next one. Bye.